everyone. Thank you very much for joining us today. My name is Patrick Ray. I am one of the retirement advisors here with the Retirement Group, and we appreciate your attention for our ConocoPhillips folks with us today. We have a lot to cover and some specific information that's correlated to the current environment and how it plays out with respect to your pension specifically. And so before we get started, I got a couple of things that I need to go over with you. First and foremost, we are not affiliated in any way with ConocoPhillips, nor are we affiliated with Fidelity. And as it turns out, our experience comes with the folks that we've met with over the years to help them achieve and maintain a successful retirement. And they're in similar shoes as you are in. And one of the tools that we utilize in an effort to bring this material to folks is the webinar platform that we're using today, where we can bring you some material and you're able to join us and kind of get an overview of the specific topic that we're going to cover. But there'll be links into the chat where you can get access to some of the things we've recorded in the past in case you have other questions or concerns that might be relevant for your specific situation. So we encourage you to check those out and peruse those at your own leisure. You'll also find links into the chat that will give you access to other ConocoPhillips related webinars that we've done that we encourage you to check out as well. And maybe the most important thing that you'll find some value out of is if you're willing to spend some time with us, we're willing to do a complimentary analysis for you under a cash flow projection, which is an effective stress test of your overall financial and retirement planning needs to kind of give you a gauge on what it looks like in case retirement is 6 months or 12 months or 5 or 10 years out, depending on your circumstance. And so we'll give you access and details on how to do that at the end of the webinar today. And last, before I turn over the presentation to Tyson to talk about today's material, I want to let you know that if you have specific questions about things that are concerning you or things that you want to know more about, please feel free to type those into the question and answer box, and we'll do our very best to get to those at the end of the presentation today. So without further ado, I'll bring on Tyson to talk about today's material. Tyson.
Thank you, Patrick. And thank you, everybody, for joining our webinar series this afternoon. My name is Tyson Mavar, one of the ConocoPhillips focused retirement advisors for the Retirement Group here in Texas. And what a year it's been so far. We're not even halfway through, approaching the halfway mark. The S&P 500 is down close to 20%. It may have affected a portion of everyone's 401k plans, but there are two things that are not down and that are actually up tremendously this year in 2022. Those two things being the company stock that many of you may have within your 401k, both ConocoPhillips and Phillips 66 stock, and something else that affects your pension plan, interest rates, both corporate bond interest rates as well as treasury bond interest rates. And for some of you may even be affected by the PBGC or Pension Benefit Guaranty Corporation interest rate. All of these play a role in your pension plan, regardless of which plan you're on. And we're going to talk about this role that they play and some of the risks going forward for any of you that may be considering taking a lump sum on your pension in the very not so distant future. So those of you who aren't as familiar with us, Patrick mentioned we're an independent planning firm. We manage retirement assets for corporate employees. We have many, many clients from ConocoPhillips and have been in business for just over 30 years, helping people manage their retirement assets and plan for a successful retirement. So a whole host of complimentary services we encourage you to take advantage of. Whether or not you're a client yet, we'd love to tell you about our company and why we might be a good fit for you and your family in retirement. But more importantly, we want to make sure that you don't make any of these irrevocable mistakes that we've seen so many employees from ConocoPhillips make and have a subpar retirement as a result of paying too much in taxes or leaving money on the table when they leave ConocoPhillips, and ultimately have a reduced retirement paycheck as a result. If you're not following us on LinkedIn already, I strongly encourage you to. That's where we publish a lot of the content related to the ConocoPhillips retirement strategies and where we continue to keep up with the changes that are happening to the benefits plans and also some of the changes we'll talk about today related to the pension. Now, there's been many mergers and acquisitions and changes with the structure of the company over the years. Many of you have worked for a different company and maybe several different companies along your career. And as a result of this, there are 8 different pension plans that you may qualify for, and actually may have multiple pension plans depending on your history with the company. And each one of these pension plans observes interest rates differently, it grows differently, has a different relationship with the timing of your retirement, the options that you have to take on your pension plan. So everybody's a little bit different. And our point in this is that it's important that we have a one-on-one conversation with you so that we can make sure that we communicate what information is relevant to you specifically, so that you're not confused about the issues that might not be pertinent to you and maybe different between you and your coworkers. Today we're going to talk about the defined benefit pension plan specifically, although many of you, if you started at the company after the merger, Phillips and Conoco, will be on a cash balance plan. And some of you that even started prior to the merger may be on a cash balance plan if you chose to switch when the option was available after the merger. So a lot of different plans, each plan works a little bit differently. We're going to talk about some of the similarities of the different pension plans and some of the issues with the interest rates on most of the plans that we run into for folks that are approaching retirement from ConocoPhillips today. Now, first and foremost, it's important to understand the options that you have on taking your pension. While today the lump sum, I would say, is the vast majority of what people are attracted to on their pension option from ConocoPhillips. The lump sum is a function of interest rates, your age, because of age penalties that might apply, your final average pay with the company, your years of service in the company, and as it turns out for most pensions, function in part of your Social Security payout because of this Social Security offset that they observe. And these payout options become a function of what is the default option, which is the straight life annuity, a single life annuity that's paid monthly for the rest of you, the employee's life. There's also a lump sum option as well as a joint survivor option, which are going to be a function of that single life annuity option. And depending on your circumstances, whether or not you're married, your age when you leave the company, your projected life expectancy, your risk tolerance, your cash flow need, and the various sources you have in retirement, there's a whole host of different variables that'll go into what option will likely be best for you and your family. But the lump sum option has been very popular in a low interest rate environment because lower interest rates produce higher lump sum payouts. And as it turns out, as interest rates have gone up, especially recently here in this last 6 months, unfortunately, that is going to produce lower lump sum payouts and may continue to reduce your lump sum payout going forward, and also may be a function of the timing of your retirement. You may choose to leave the company as a result of trying to avoid losing money in your lump sum. And that's where we spend a lot of time with our folks as they approach their transition from the company. Even if when you leave ConocoPhillips, you're not planning on retiring, maybe you're going to make a lateral move in the workforce or maybe do something completely different. Many people that we've worked with over the years have picked a retirement date based on maximizing their lump sum payout and also giving them the ability to now go invest that money that is in their lump sum rather than watch it deteriorate in a rising interest rate environment. So this is something we encourage you to focus on, and we're going to talk about the specific interest rates in just a moment here. But I can't stress enough that the lump sum is not the most appropriate option for everybody. And that cash flow analysis that Patrick mentioned earlier, something we do complimentary for everybody at ConocoPhillips, we use as a tool to compare the potential benefits and potential detriments of the different pension options. But it's also important that you and your advisor, whether it's us or some other group that you've been working with, get an understanding of what's important to you and your family and ask a lot of questions before recommending what option is likely going to suit you and your family best throughout your retirement. Now I'm going to zoom in here so we can see what's going on with the current interest rates. First, important to understand that each plan is affected by interest rates differently. What we're looking at here are the interest rates for the corporate bond interest rates, first, second, and third segment corporate bond rates, also known as the present value segment rate or PPA rates. These will affect the lump sum payouts for anybody on a defined benefit plan. So that would be Burlington Resources, Phillips Petroleum, Conoco Inc. All of those defined benefit plans have a negative correlation with interest rates. And for your service past 2008, your lump sum will be calculated using these three interest rates. You can see there's a lot of moving parts and it starts to get complicated. For your service prior to 2008, if you're on one of the Heritage plans, you'll be using the 30-year Treasury, which you can see in the right column here. And for Conoco Heritage employees specifically, your service prior to 2000 will use a rate that's not even shown on here, which is the PBGC rate, which is actually increased from 0%, which it was for several months. It's actually at 0.5% now. So these rates are changing on a quarterly basis. We actually watch these rates on at least a monthly basis. I pay attention even more often than a monthly basis, but the segment rates, these corporate bond interest rates, change monthly and are published by the IRS. And we can share the website where you can track these if you're interested. The 30-year Treasury rates change daily, but they change as it pertains to your lump sum payout on a quarterly basis. So let's talk about the timing issues here. You can see at the very top of our table here, we've shown what the March 2022 interest rates are. The reason that's relevant is because it's the 4th month prior to the 3rd quarter. So the way ConocoPhillips observes these lump sum interest rates, they're going to look at the 4th month prior to the quarter that you commence your benefit, not necessarily the quarter you retire, but the quarter that you fill out your paperwork and choose a benefit commencement date on, which doesn't necessarily have to coincide with your retirement. You could defer the commencement of your pension. And there's a variety of reasons we recommend people do that. But in a rising interest rate environment, oftentimes it makes sense to commence your benefit as soon as it is available, which is the 1st day of the month following your retirement date, assuming you get your paperwork in on time. Something else to keep in mind, whoever you pick as an advisor, whether it's us or one of our peers in the industry, ought to have some clients from ConocoPhillips so you can have confidence they're going to help you fill out your paperwork correctly, because this becomes essential in increasing your pension benefit by maybe tens of thousands of dollars, or in the environment that we're in today, could be over $100,000 more or less in your pension, depending on whether or not you get this right. So March, they just published March at the end of April. And as it turns out, they actually just published the April interest rates only a few days ago. The segment rates, the rate that carries the most weight in your pension payout is the 2nd segment rate, which is based on intermediate corporate bond interest rates. Now, we've shown what rates have done over the past just over a year, and we track these. We saw a lot of people retiring as a result of historically very, very low, in fact, all-time lows at one point, interest rates, which have produced all-time high lump sum payouts. Now, what's happened, unfortunately, in the last several quarters is that interest rates have gone up the last 2 quarters in a row. And if we were basing it on the information that came out in April, it seems fairly likely that interest rates will go up again into the 4th quarter. So those of you that may have missed out on the opportunity of the 2nd quarter interest rates, which were based off of December corporate bond and treasury bonds, if you didn't retire by the end of May, which is coming up next week, then unfortunately the interest rate that you will be, the next interest rate available to take your lump sum is going to be the 3rd quarter, which is substantially higher. You can see the 2nd segment rate here. It's almost 1% higher than the 2nd segment rate in December for 2nd quarter. What that translates to in plain English is roughly a 10% drop in your lump sum from the 2nd quarter to the 3rd quarter. So I encourage you to run lots of different projections in the pension modeler to see different retirement dates as well as different interest rate assumptions and what that does to your pension. And the first time I go through this exercise with folks, most people are shocked at how sensitive that lump sum is to rising interest rates. And if you have, let's just keep the math easy, say it's $1 million lump sum, 1% increase in rates is going to result in a $100,000 loss in your lump sum overnight at the turn of the quarter. And that may be too much money for many of you to be able to lose in such a short period of time. Now, of course, we have to assume that you can afford to retire, or maybe you have a plan of maybe working a part-time job to transition into retirement. There's all these things that we could do, but we have to first be aware of the issue, and then we can start to build a plan to maximize your retirement income as a result of maximizing your benefits payout from ConocoPhillips. Treasury interest rates didn't go up quite as much in the 3rd quarter, but even with the increases that we've seen this year, we are still very low interest rate environment historically, And this is a big risk for people that are considering a lump sum. Now, if you're on the defined benefit plan and you are 100% certain that you are taking the annuity option from the company, this is not an issue for you because the annuity will continue growing as long as you continue to working for the company. It'll grow even faster if you get pay increases over time. Of course, the company may potentially freeze these heritage, these grandfathered plans that many of the folks that have worked for the company for 20 years or more are on. That's a possibility given the changes that they've made in many employers and companies that pay pension plans have made over the last really couple decades. So we pay close attention to this because this might mean considering working in a different company. It might mean changing your retirement date, might mean saving more in your 401k or planning to spend less potentially, depending on what happens with not only the interest rates, but with the benefits plans at ConocoPhillips going forward. So pay close attention to this, folks. We'd love to spend a few minutes to educate you on how these rates impact your plan and the implications going forward in an inflationary environment, in a rising interest rate environment. What's that going to do to your overall retirement plan? But it starts with building a cash flow analysis and then manipulating that cash flow analysis over time as more information becomes available and we know more about the future. Unfortunately, statistically, 74% of Americans do not have a written plan for retirement. To Patrick and myself and us here at the Retirement Group, that is unacceptable because it only takes probably 15 to 20 minutes of your time to put together the plan, and usually about 20 to 30 minutes to go over the plan. And then at least you have a foundation of a retirement plan. And then we might have to pivot over time as we see changing economy, changing rules and regulations on the tax code, changing stock market, changing benefits plans. But at least putting together the baseline, I promise you, will make you feel more comfortable that you are in good shape to retire one day, even if it's not today. Or there's some things you need to do now to improve your position to retire. Even if that's the case, just knowing what the next step is, I think, helps to build people's confidence and comfort level with that transition. So please spend a few minutes with us if you haven't already, or if it's been a while since we've updated your plan, let us know so we can get it updated, as we've seen so many things change just in this last 6 months. With that, we're going to wrap it up and switch over to questions. But if you have any specific questions or want to schedule a call with one of our ConocoPhillips folks advisors, you can email us at info@theretirementgroup.com. You can schedule on this QR code, take a picture of it with your smartphone and get on the calendar of somebody, even if it's just for a 10 or 15-minute consultation. And you can call us at the home office at 800-900-5867. We'll do our best to put you in the right direction, even if you're not a client of ours already. We're most interested in helping people make good decisions at ConocoPhillips because that's how we've grown our business the last 30 years and maintained a good reputation among the ConocoPhillips community. So with that, Patrick, we're going to pass it over if we have any specific questions or if you have any last minute housekeeping issues you'd like to bring up.
Yeah, for sure. Got a couple of good questions, actually. So let's get right to it. So for the ConocoPhillips plan, I understand it's a guess, but do you have an estimate on how much my lump sum from ConocoPhillips will drop in June of 2022?
Yeah, good question. It is a guess, and it's variable. It's dependent on how old you are. The younger you are, the more sensitive your lump sum is to interest rate increases. It's a function of how long you've been at the company. My best advice would be to go into the pension modeler, and if you're not that familiar with how that works, call us and we'll walk you through it. But like we mentioned earlier, for a typical 60-year-old, every 1% increase in the rates is about a 10% drop in your lump sum. So do that if you don't have time to go into the modeler, but I strongly encourage you to not only run one for next quarter compared to this quarter, but run a couple projections for your ideal retirement date, maybe 6 months out, and run a plan to see if you might need to retire earlier. It might make sense to leave the company earlier to save some money on the pension, or if you just need to stick it out and work a few more years, or maybe even consider the annuity option if interest rates really get out of control in the next couple of years.
Yeah, and to piggyback off of that, that's absolutely the benefit of running a cash flow projection where we can help you determine which one of these directions might be better suited for you. And remember also, part of our responsibility to help bring the most value to the table to you is to help you maximize the pools of capital that you're ultimately going to rely on when you retire. And that may mean changing or making a shift in thought process as to how to maximize what you have at ConocoPhillips as an example, but not necessarily be prepared to just flat out retire the minute you leave. So these are all things that we've been more in tune with talking to folks about because of the current changes and how free, and mostly how fast they're happening, because these rates are spiking very, very quickly. Here's a good question, Tyson. Why do I have 2 Burlington Heritage pensions?
Oh, good question. So because of the changes and the mergers with the company, they changed the pension plan. There's a defined benefit plan, and that's the one that we focus most on today, where rising interest rates reduce your lump sum. But there's also a cash balance plan that gets salary and interest credits, and rising interest rates are actually helpful for that plan because it grows at a faster rate. It gets better interest credits. So the two are completely different in terms of how they grow and some of the timing issues, but that's the reason, just because the company changed the rules over time. And now all the plans are harmonized so that any new employees are having the same benefits plans, which I'll be honest with you, aren't as lucrative or aren't as beneficial as the old defined benefit pension plan. So we've been going in a direction of lower and lower benefits, and many would argue for good reason, because of how competitive the workforce is, the industry competing for great employees like you. I will say that ConocoPhillips has some of the best educated and most valuable folks in the country. They're many of our clients, but across the industry and really across the country, benefits plans like these have been getting reduced, and the burden has been shifting more toward the individual to save more in a plan like a 401k or a traditional Roth IRA for their retirement. So hopefully that answers your question, but if you got more detailed questions on your Burlington Resources pension, give us a call. We'll spend a few minutes with you.
Okay, last question, and it's a good one. The question is, do I get the Title I plan or the Title II plan? In other words, when I retire, do I get both, or can I just rely on one, or how does that work?
Yeah, I'm just going to go back to all the titles so we can bring this up for everybody who may have the same question. So you can see there's 8 titles here. Title I being the Phillips Retirement Income Plan. My guess is that individual worked for Phillips before the merger. Title II came out after the merger. It's a cash balance plan, not as lucrative, but the company almost encouraged employees to switch over to this plan. They gave folks an option to stay on the Heritage plan, whether you were Conoco or Phillips, back in, I believe it was 2003, or switch over to this new cash balance plan, which they advertise it as being more portable. You don't have to meet the age and service requirements, all these benefits that they advertised. And I know a lot of people that switched over for whatever reason. If you did switch over, you have both plans, but your service beyond that point is credited based on the cash balance plan, but you still have the old Phillips plan. If you chose not to, which is what I would have recommended almost everybody at that time, had I been talking to them, if you chose not to switch over to the cash balance plan, you'll just have that one Phillips pension, and you will see all of your pension plans if you log into the pension modeler online. And also something, this is not part of this question, but if you are what they call a key employee, or what the government calls a highly compensated employee, you may also have something called the Key Employee Supplemental Retirement Plan, or the KESRP. And what this is it's based on IRS 415 rules that unfortunately disallows you from being able to roll over your entire lump sum when you retire, and therefore being able to defer taxes on that money. That will become income and can become a tax problem for you, and may warrant a different retirement date as a result of the tax consequences the year that you leave the company. So a lot of issues with that, but for the individual's question, you'll be able to see it if you log into the model, or let us know if you're not able to find that or need some help finding that. We'll walk you through it. And you may have 2 plans if you decided to switch over to the other plan when the companies merged back almost 20 years ago now.
Okay, well, those are great questions. And with that, we'll leave you for the afternoon. We hope that you found some value in spending some time with us today. These are unbelievably vital tips and tools and things that we do in an effort to help folks who are in positions similar to yours gain and maintain a successful retirement at some point whenever you choose to do so. So feel free to reach out to us at 800-900-5867 in the event that you have questions or concerns or would like to chat further, and we're delighted to do so. So having said that, we'll leave you for the afternoon. Everyone have a great day and stay safe.
Thank you, folks.